Hello, everyone. Welcome, welcome, welcome. I'm Peggy Beauregard. This is the Nest Egg Builder Show, and we meet every week, as you know. And we have an amazing speaker today that's going to talk to us about becoming an accredited investor. And if you're not one, you'd like to learn. And if you are one, there's all kinds of things that you can do. So we work with a limited partner, the person that wants to be a passive investor in real estate, so they don't have to learn all this stuff that actually our speaker, Matt Harms, put this book together, and it tells you everything you need to know to be a very active investor. And it's very well written. It's very clear. It's very concise. So I suggest you get that. We have lost one of our very, very great gentleman who was somebody that I admired a lot. His name was, I guess it still is, Charlie Munger. And here's what he had to say. The best thing a human being can do is help another human being know more, which is why we are so glad that we have Matt here, because he's going to have us learn more. So thank you, Matt, for being here. Matt is not only is he a real estate agent, wrote this book called Get Real and tells you all different ways that you can put deals together. And as a real estate person, he could help you do that. And besides writing the book, he also is a passive investor, and he invests in a lot of different types of real estate. So it's really important to know all the different asset classes and what you can and might want to do and not want to do. So thank you, Matt, very much for being here. Take it away.
Thank you very much for having me, Peggy. I appreciate it. So I'm going to start by saying there's no magic answer, and there's no one right way to do things in life, especially within real estate, if you want to reach the accredited status. So just to start, do I have screen sharing? Yes, I do. Cool. So let me just first start by defining what an accredited investor is. So the definition of accredited is the same for any type of investment vehicle, and you need to meet one of these three criteria. The first is having a net worth of over $1 million. For anyone who doesn't know what a net worth is, that's having either $1 million in the bank or having $1 million in equity in some type of real estate investment. You can also become an accredited investor by having an earned income by yourself of $200,000 a year or $300,000 a year if you're filing jointly. The third way, I'm just going to mention it since it is included in the definition, but really, as far as I'm concerned, it doesn't hold any weight. It's having your FINRA certifications or licenses. Just because that entitles you to the name of accredited investor doesn't really give you a whole lot of ability to make any investments unless you've got some type of net worth. So my disclaimer, which I kind of just gave you, we're going to ignore option 3 for the sake of this presentation. I myself went from nowhere near an accredited investor to an accredited investor in 3 years, using a lot of the real estate strategies that are in my book, Get Real, and some of the ones that we're going to speak about today. I know Peggy and Nest Egg Builder very much on the passive side, and that is really the dream for most real estate investors. If you don't want to be overseeing contractors as you're flipping homes, if you don't want to get phone calls from tenants in the middle of the night like I have been getting for the last couple days because of the snowstorms and rolling blackouts, passive is where your money is working for you in real estate and you're not putting up with any of those other headaches that I just mentioned. However, you've got to start somewhere. So my purpose today is to kind of give you the roadmap of things that I've done to get to that status where I'm now able to participate in some of these more passive type of investments that Peggy and her team put together. So let's look at qualifying on net worth. I want to give a couple examples of ways that you could qualify on net worth. You can leave it in the bank earning 4% interest. So I don't want to go into a basic finance discussion here, but there's something called the rule of 72, which tells you how long it takes for your money to double at a given interest rate. So if you can get 4%, which right now, because inflation's through the roof, you probably could, it's going to take you 36 years to grow $250,000 to $1 million. And that's if you're starting with $250,000. Okay. For all these examples, I'm just going to assume you have $250,000. You can invest it in the stock market. There's no way of knowing how long that's going to take because the stock market is pretty unpredictable. So you may be able to double that $250,000 overnight. If you're a really good day trader, you could also lose it overnight. And now you're back to square one. Third option, which is one of my particular favorites and a strategy that we used very heavily, is use that money to buy an undervalued piece of real estate. Do some renovations to it, watch the property appraise for significantly more than you paid for it. So I want to talk about the exponential effect of using that third option. Let's say you buy 2 undervalued properties for $100,000 each. So that's 200 of the 250 that you have sitting in the bank. Spend about 25,000 of the 50,000 remaining to renovate each, and watch those properties now appraise for somewhere between 175 and 225. If you're wondering where you can buy homes for $100,000, there actually are plenty of markets in the United States where this is completely doable. We've done it over 24 times. In fact, they're some of my favorite markets because you get to spread your money out more, a lot further. Word of caution, again, with all investments, make sure you understand the market. Make sure that just because a house is selling for 100 doesn't make it a good deal if the rest of the market's appraising for 90. So have a little knowledge, do some homework, work with a trusted real estate professional, whether I'm just going to plug real estate brokers and agents here for a minute. They do get paid for a reason. Hopefully they are specialists in the area you're looking to work in. But doing something like this, our average time to renovate and get a house to appraise for these values is somewhere between 3 and 6 months. So you can see how just in a few months, you've taken your net worth and you've added somewhere between $50,000 to $200,000 by employing this strategy. So now you're, instead of being 25% on the way to being an accredited investor, you're 50% on the way. Now let's apply the same principle using other people's money. So you can buy 2 undervalued properties for $200,000 each, only put down 25% of your own money on each property and mortgage the rest. Invest $50,000 on renovations for each. Now these $200,000 properties, if you've bought them right, you've done the right renovations that give you the most market appreciation, you're going to watch them appraise for somewhere in the area of $300,000 to $350,000. Refinance if you don't want to sell them, because again, I am big on selling certain ones, usually are single families, keeping the multis, because the rental income that we get, yes, it's active, and again, not probably where you want to be when you've got 100 tenants, but thankfully we have a property management division that handles a lot of those headaches for us. But you can now turn around, refinance those properties, continue to rent them, earn the income, which is going to help you meet the accredited status on the income side by getting to that 200,000 in earned income, or 300 if you're filing jointly. Take the cash out, so all that equity you made doing these renovations, and buy some more property. Repeat, repeat, repeat. The more you do this, the more you're adding to you, not only your earned income, but also to your overall net worth. So before I overcomplicate the strategy, you could also just go find a job that pays you $200,000 a year. However, in the current environment, one, there's, you may have one. Jobs are not guaranteed. You could lose your job overnight. Your accredited status is now out the window. So back to real estate. I mentioned earlier, there's no right or wrong answer. Consistency is the key. If you're building your way up to becoming an accredited investor, pick a strategy and stick with it. So if you really love renovating and flipping homes, focus on that. If you love the warm and fuzzy feeling of getting rent checks every month and having additional income where you're not trying to constantly flip something, go with that strategy. Don't overextend yourself. I mentioned using other people's money. There are plenty of ways you can do that. The safest strategy is to put down 25% of your own money. Use a traditional bank. There are plenty of strategies out there. If you're interested, again, in my book, we have bought property on actually fairly often with zero money down, and really managed to extend our liquidity. Reinvest your profits. Once you start making money, don't lose sight of the goal of becoming an accredited investor. If you're taking all of the extra income you're now earning and you're increasing your own personal housing payments, you're buying cars, you're buying fancy toys that cost money, those are liabilities and not assets. Buying a Lamborghini is not going to count towards your net worth, no matter what you think it's worth, even if you pay for it in cash. Always have your money working for you. I think that's really what Peggy and her team are constantly doing with the deals they bring and offer to their investors. Your money needs to be working for you harder than you're working to make more money. And I know I kind of flew through that. So if there's any questions, I'm happy to cover them. But really, again, back to my personal situation, we do a number of flips every year. We now have 72 of our own rental units that are contributing to that earned income. It is a very active strategy, but it has opened the doors for us to be able to use the rental income from those units and whatever equity we have when we buy and flip a property to get that money working for us in a more passive strategy. Because with active real estate, you're only as good as finding the next deal. And if you're currently an experienced investor, you probably know that no matter where in the United States you are right now, inventory is very low, interest rates are very high. And if there's no deals out there, you can't make any money. So that's where passive investing and having that accredited status opens doors to earning additional money and being privy to additional opportunities that Peggy and her team have.
Thank you.
You're welcome.
So my understanding about accredited investor is it's asset based. It's not real estate based. So you have to have a certain amount of equity. Can't count your own home. So any part of the property that's debt-free, debt. But if you did own a Lamborghini and it was free and clear, whatever that value, that is an asset. All your jewelry is an asset. Anything that's debt-free is an asset. All the furniture in your home is an asset. So you don't necessarily have to go out and buy, but the way you said it, in four to six homes, someone would be an accredited investor if you kept the debt on it.
Well, yeah. So if you are financing and leveraging, you're absolutely right. The only
right. And selling and flipping a property is not going to get you to be an accredited investor because you don't have that equity. You just went into cash. So now you go buy another house. That's good. There's nothing wrong with that. Just another viewpoint is when you flip properties, you're not building any equity to become that accredited investor. Whereas if you're holding the property, you're fixing it up and you're holding it, you now have equity in it, right? Because you have to leave equity in it when you do the refinance. So whatever that may be, the 100 or 150, and then every time, as you said, you make a payment, you pay that down, your equity grows like that. So Latina's an expert in that because she buys lots, builds homes. She also fixes up property. She owns a lot of rental properties also. So that's a great way to become an accredited investor. And like you said, go where you can spread your money out further, which is really great. Or go work with somebody that does all of that and be the passive investor for them. Like the group that came on last week and talked about how they took 80 units, rehabbed them, and got them all rented out in 1 month. And by the time they got done, and in the 6 months, they had tripled the value of the property. So then they could do a refi, pay everyone back their money, and then for those who got to stay in would get that cash flow, which is what we like everybody to do, is fix up the property, refi, give me my money back, keep me in there so I get my cash flow, and give me another deal to invest with you. Like that. Just keep doing it over and over and over. And eventually you will get to be, we don't like the eventual. And there's now another way to become an accredited investor, and that's to take a test. It's called the Series 65 test. It's 130 questions. It's probably a good idea to study and then take the test and pass. Hire somebody to teach you if need be, because that series is about stock, which who cares about stock, and bonds, which are okay. I think it touches on insurance, and I'm not sure what else it touches on. I'll get that all reviewed soon. Jonna, question or comment?
Yeah, it's a combination of a question or comment. I think real estate is nice because, especially rental, is nice because the tenants are paying down the principal. Correct, Matt? And you can then, as you get the higher valuation, you can borrow against the equity of it and buy a larger property and have tenants pay that one down as well. And it just snowballs faster than savings. Is that correct, Matt?
That is 100% correct.
Mm-hmm.
And you can do that actively or passively.
Mm-hmm.
And the nice thing about that, Jonna, is they're not making any more real estate, right? There's only so much land. And as far as housing goes, there will always be a need for residential housing. So as part of the strategy, if you're going to be active on the road to becoming accredited, as long as you're screening your tenants, people always need a place to live. And rents never go down.
That's not true, but okay.
Here in New York,
where
think it
all
was
the rents went down. So I was in California and all the rents went down because they couldn't get them filled up. We live in a different world now, but rents went down. So you always have to be cautious that could happen. You never know whether you're going to have such an influx of, or such an outflux like Detroit. Detroit's gone through and it still has not come back completely because people left Detroit. They left for many, many different reasons. You have somebody like Latina who's making a difference there. We know Michael, a few other people are making a difference there and bringing that town back to where it needs to be. But it's taken 30, 40 years because they've been in negative all this time. So you, again, and Matt brought this up, do your due diligence, know the area. Don't just go into an area because somebody said it's a great area, you can make money.
And pay attention to the warning signs, Peggy. If you see big industry is closing down, I mean, you can usually, not that real estate is a liquid asset, you still have to sell it, but don't wait until it's too late and you run into a situation like you just explained in Detroit.
Yes, and that does happen, especially if you've got like a one business town and everybody depends on that business for a living. You gotta pay attention to what's going on.
Yep.
Jonna.
Yeah, I think the other piece here that's relevant, Matt, is the income from rentals can be added onto your income, right? If you're close on the income, you don't need very many to push you over that line, or the income from a passive investment. And the other trick is to lump sum your pension, because you can't use your pension as net income, but if you take it lump sum, it becomes an asset.
But it's still an asset sitting in your, wherever it is, whether it's in your IRA or with the company.
Yeah, once it's in your IRA, you can use it to invest either in an annuity or
right. But it still could, if you have $500,000 or $600,000 in your retirement IRA, whatever it may be, with the company, that's still an asset to you, which could actually make, a lot of people don't even think to count that, and that could make them an accredited investor because they've got such a large amount, unfortunately not invested, just sitting there in the account because the companies do the investing for you, and usually the stock market. So what else, Jonna? Anything?
No, I think there's a lot of ways that people don't realize that they can, little tricks that they can use to push themselves over the line to become accredited.
Thank
Thanks.
you. Latina, you've been doing a lot of things lately. Do you have any comment to make regarding becoming an accredited investor, or how's that going for you in Detroit?
Well, I mean, yeah, I've been quite busy. It's cold here as well, so uh but I did have a question about the accredited investing. I do have a, project when I met Peggy and Cliff that I invested in. If, Matt, I don't know, like when you have I'm assuming you probably have like a email list of folks that would be interested in maybe perhaps, venturing off with you. How does that work if you have a deal? Do you reach out to those folks, or like what is it like, what's your process?
So on the passive side, I actually don't. That's where Peggy comes in. I'm more on the
Okay.
active side as a real estate broker. So generally, if I am looking for deals, that I take them myself. Like we just had a situation come up the other day where a realtor in Pennsylvania reached out to me because they have something they're about to list. It's 7 units. I'm not in the market to buy anything right now because we have our capital tied up in another project. So I'm bringing that to, as you mentioned, some of my investors who we work with. I'm going to gauge the interest and then potentially wholesale it to them, which is another strategy I kind of touch on in my book.
Mhm. Okay. Okay. How can we purchase your book? Is it through your, I think I
It's
see
on
your,
Amazon.
Amazon. So
Okay.
Latina, if you want to raise if you're doing deals, so you already have rentals,
Mhm.
and you've got the project, I don't know whether that got finished or completed or not. But let's say you find something else you want people to come in. So let's say you find something that's $1 million and you need to raise the equity, right? 200,000,
Mhm.
you could get a
Right.
loan for the balance. Oh, plus you want to raise the capital you need to do the fix up, all of that, and the closing costs all at the same time. Well, you just go to all the people you know, right?
Right.
Or
Yeah.
or do you come to someone like us, because that's what
Exactly.
we do. And remember, if let's just say you're not an accredited investor and you are raising those funds,
Mhm.
your portion of the ownership is all you get, that part of the equity. So let's say you have 10 people in it, you've got 20% of the deal, they've got 80% of the deal. Your 20%, the debt-free part of that 20% is what counts towards the accredited. Not, you don't get the whole
Not
thing,
the
right?
whole-
Because you've got all these other people now, and their portion helps them become accredited unless they're already accredited. So
Okay.
every dollar counts, but you have to figure out the dollars. So if somebody comes back to you and says, look, I'm working out what my accredited, and we've helped people do this. We just go back to the syndicator and we say, what is the portion? Well, we ask the people to pull their documents because it's supposed to be in the
Mhm.
document.
Right.
So let's say you're a 2% owner of something, go back to the syndicator and you say, have you done an appraisal lately? We want to know what the current value is, so we know what the current holding is for this person. And what is the debt, so that they can figure out what their equity is on it.
Okay.
So it's math, it takes time, but
Yeah.
that's for people that are inching up, so to speak, to get to be accredited. We work with them to make every dollar count. And we've had people think that they're like $5,000 away, and then they find out, oh, I've got this other $50,000. Okay, well, I'd say you're accredited, now go get certified. But you can
Right.
go back to your accountant and have them certified that you're accredited.
And in that same example Peggy gave, Latina, if say you found that $1 million property and you didn't have the funds yourself to get it done, but you knew based on your experience in the market. Let's say it's worth 1.5. I'm just going to throw that out there. You go and get it under contract with the wording that it's whatever the purchaser you and or assigns. And that gives you the legal right to sell that contract to somebody else for whatever amount you.
Okay. Good to
There's
know.
that. Then there's also lenders that like to work with flipper. Well, you don't have to be a flipper. You could be a buy and hold person, but they will lend you after they've worked with you. They'll lend you 100%. But to begin with, they have whatever their standard is, and they'll bring in the loan, and then they'll also bring in the amount of money that's needed the capital that's needed to fix up the property. And then what you do to pay them back is you do the refinance and put your long-term mortgage in place and pay them back. And you've got to and you probably pulled some cash out. A lot of times, another thing to do that you could do, now we're into strategies, is instead of bringing someone in as a partner, you bring them in as a lender. And then at the end, when you do the refinance, you pay them all back, so that they're more on the lender side than the equity side. So you have to find out whether people are happy with that. And just here's my theory on that is, know your investors and what they want. People if you want to be a long-term investor, then make sure you're bringing in long-term investors. If you're a short-term investor, great, do the note kind of thing. I talk to people all the time, and they've said, oh, we got this really great deal, 3 to 5 year hold. I'm like, why are you selling it if it's such a great deal? Oh, the investors want their money back. Well, you got the wrong investors. Get the long-term investors, get the people that want the lifetime investment, because how do you know at the end of your 3 to 5 years that you could 1031 into another deal? But if people want their money back, you can't do a 1031. Everybody has to pay capital gain. How are you protecting your investor if you're setting them up to pay a capital gain? So why not do a refinance, pay everybody back their initial capital, and if there's some profit, and keep them in the deal, or buy them out, whatever, so that they're there for a lifetime.
Peggy, we have very specific investor agreements when we enter into things like that. So our investors can't ask for their money prior to whatever the minimum hold is. And I would almost always rather take an investor than a partner, because partners have a legal say in whether you sell that property or not. And you don't always want to be at the behest of somebody else saying, you know what, I want out of this business now, and now you're stuck selling $1 million, $2 million, whatever the asset is, because you also don't control the market conditions you're selling it in.
So you take in an LLC, so you have an LLC, and each person comes in an LLC, and you're saying they have the right to say whether you have to sell or not, even though your PPM says they don't.
Well, I was speaking to two different scenarios. The investor, okay, or if you take a partner. So let's say I partner up with Latina today. We set up an LLC. We go and buy a property as 50-50
okay,
partners.
So not a passive investor.
Correct.
Okay. Because a passive investor is still an investor.
Yep.
Okay. Yeah. So if you do a partner, you don't want a partner. You want an investor. Right. Because you want to get them out. Because you want the whole thing.
Mm-hmm.
But here's people like me. I want to be in something for a lifetime. Even beyond me, I want something to continue to go, because my what I see for the future is, it's not about me. It's my contribution back to a community. So I want lifetime. I see how are you I don't even know how to explain, and I get frustrated by it. Sorry, everybody. It just frustrates me, because back in the 90s, you could buy properties and you could get a 13 to 18% cap rate and pay people that cap. You fixed up the property, you made it a good property, and you hold it for the next 20 or 30 years or forever. And you can't see, you don't see a cap rate like that anymore. When you were buying an A-class property, which we used classes back then, an A-class property, a turnkey, that means you didn't have to put a dime into it. You could get an 8 cap on that. A property that needed work usually ran about 13 to 15 cap rates because they were vacant, they weren't taken care of, but you did not sell them, you held them. Because where are you going to find a deal like that today? Nobody even talks about cap rates anymore. They talk about cash on cash. They don't take any of the cash flow because then they can't pay anybody back. I mean, it's crazy how they put the deals together today. Just crazy. So I got off of Accredited Investor and got into finding a good deal when you find and make, because you can make the deal good, and there's always good deals out there. Why would you ever let a good deal go? That's just me. I don't want to be in something for 3 to 5 years because I'm going to live to be 130. And one day I'm not going to be doing this, and I want that cash flow. And I don't want somebody telling me, oh, we're selling the property, you're going to get your money back. But I don't want my money back. I want the cash flow on it. I want my principal protected and growing. Guys, things are going to change. They are going to change. Taxes will go up. I don't want to pay taxes, more taxes than I'm paying. Just watch. I was reading an article today about someone who was saying, used to say, oh, you take 4% of your retirement every year and you'll be fine for the rest of your life. Well, that doesn't work and it's not true. But why would you ever spend any of your principal? You protect your principal. You get it invested in 8 to 10% returns and always have it protected. Never spend your principal. My philosophy, never spend your principal, always make it grow. Because guess what? You have to keep up with inflation. 4% ain't going to do it. Chana.
I think when we started, I think a good question to answer on here is, why do you want to be an accredited investor? Why is that important, Matt?
It opens at least for me, and I'm sure there's many answers to this question, but for me, it opens the door to these fantastic opportunities you wouldn't be able to have otherwise. Anyone who says that they love being a landlord and actively investing, they're either a little nuts in the head or they've got a team of people doing it for them. And if you want to do business with Peggy and the developers and the folks that she works with, you need to have that accredited status. So kind of like anything in life, you got to roll up your sleeves and put in the work to get there. Real estate's not the only way. It's the way I did it. It's the way I would prefer to do it. But yeah, that's my reason.
Okay,
Thank you. Eugene, what about you?
What's the question?
What about you? Aren't you doing some real estate and working your way up to accredited? Or are you already accredited?
Yeah, we're already accredited. But honestly, we didn't do it working out a plan. It's just how life was for us. We became accredited. And I really didn't even think about it until somebody told me I was.
Okay.
I do have one comment though. We make 5-year bets. We don't even though I'm going to live till I'm 120, like you say, we've got no problem with deals that we get our money back at the end of 5 years. When we look at deals, we're looking at 5-year bets. We're not looking at 20. That's just part of our strategy. We might stay in it longer, but that's what we look at. Also, when we put together deals, we put them together as, what's it look like at the end of 5 years?
And then
That's
And-
just our approach and our strategy.
And if it looks like that at the end of 5 years, you'll let it go, or if it doesn't look like that,
We
you'll,
may not, but that's just I don't, I don't make 20 or 30-year bets. I just don't do it. I make 5-year bets.
did you ever think about, or did you, like, when you started looking at how long you were going to hold something, did you look at what the differences were if you held it longer or held it shorter or any of that you came up with the 5 years?
No, always looked at it 5 years.
Okay.
And this was something I started a long time ago. I'm not even sure when it was. Such a long time. It's just been ingrained in, so we look at things on a 5-year basis.
Okay. Well, keep your eyes open, because sometimes you have to pivot because the economies change or other things happen. What about you, Patricia?
Well, it's interesting because I find myself with lots of friends who are like, "Oh, you buy this thing and then you sell it, and that's where you make the money." And I'm like, I tend to more like towards, Peggy's position is like, well, I kind of like that cash flow for the rest of my life. So it's a challenging. I am just a newbie. I am nowhere near accredited at this point. But I mean that's certainly a goal. But yeah, that's where I fall in the spectrum of things.
Okay, great. Thanks for sharing. And Lisa's here. Oh, and Ms. Williams has appeared. How nice of you to join us today. So does anybody else? Mark, you have any thoughts? You, Mr. Real Estate, who own how many doors do you have now?
Let me ask a question for Matt. So,
Sure.
is then your philosophy that the active real estate investing is more or less a means to the end goal of investing with Peggy and getting to that point where you can do that on a more passive level? Is that kind of where you're coming from?
Yes and no. So I love everything about real estate. So getting to the accredited status was huge because I'm going to use the word diversification here, but strictly in the terms of real estate diversification. I want passive investments. I still, I guess maybe because I have a team that does a lot of the management, except when things like really hit the fan, like this storm, I like having that income coming in from rental properties because I know I also own it entirely. 100% under my company. So I'm going to get the appreciation. And I do like from time to time doing flips, especially if it's a really good deal, just seeing that property turn around from something that, was an eyesore to now making someone a happy homeowner. So I'm kind of across the board there, Mark, but I hope that answers the question.
Okay. Yeah. Thank you.
Do you ever consider so you fix up a property, you get it rented out, let's say, making up a story, and those people come to you and say, gee, we'd really like to buy this house. It's really nice. We like what you did to it. Would you carry back? Do you consider that?
Do not, ever.
Is there a particular reason?
I do not want to be the bank. You're getting to live in the house that I already own, and no, that doesn't work for me yet. And I almost feel bad saying this because the first question I ask anyone I buy a property from is if they'll carry back. And we've gotten fortunate more often than not that people will do it for us. But I also structure those deals in ways where, that they're very confident that they're going to get their money and I'm not going to sit there and be paying them for 30 years.
Mm-hmm.
So I will not. One thing we have done is we've offered rent to own clauses, especially if let's say it's kind of a backup exit strategy for properties that we thought we were going to flip. And then for some reason, maybe the market turned against us. Or things just didn't go the way we planned, we would rent it with a rent to own clause. So this way we're at least making some money and this person has price protection to buy it in the next 2 or 3 years.
Yeah, so like a land trust.
Mm-hmm.
Yeah, okay. Well, one of the reasons I ask, because I always thought the best thing to ever do on a property that you own is to do a carryback, because if they decide they're not going to pay, you get to foreclose on the property and now you get to sell it again and it's a different market. So you get another down payment and you get another mortgage and you get all that interest. I just see that as a really great way to, they either get to pay it off in their 30 years or they're going to refinance it when they get their credit better or whatever. And then you're out, or you end up with the property back and get to sell it again. Same with the land trust. When you're doing that, you know, people don't stay in one place forever. So they rent to own for 7 years and they say, oh, we're out. Now you get that you didn't have to go through a foreclosure.
Very valid points. And now that you've positioned it like that, if someone asks me in the future, I'll look at it a little differently. I'm not going to guarantee I'll do it, but I'll definitely look at it a little differently.
Yeah, all the ideas, you know, there's just so many ways to put deals together. It's not just cash to loan or have the seller carry back. There's other equities. So people don't even think about that, especially when they do a 1031. You know, a seller could come in and say, you could be the seller of your property and you want to do a 1031 and you could be doing a carryback. And that loan can now be the down payment on the next property. You give the loan and the cash to your accommodator, and now you need to find a property. Well, they'll take that for a down payment, or you could find somebody like a DST that'll give you cash for that note, and now you have all cash to do your down payment on a 1031. So there's just so many ways to put a property together, and most people only can think one or two ways when there's 100. And, you know, you can always give an equity as a down payment too. Most people don't even think about that. Like you have, I don't know how many properties you have, but you have a lot of properties, and you could actually create a note on a property and give that to the seller for your down payment and get your bank loan for the balance of it. Because now they're getting paid off. So it looks like you gave them all cash to the bank, but they're actually holding a note on another property. So you just gave them an equity position in another property. Just need to be working with people that understand that. And anybody that owns a rental, if they got all that cash flow, don't you want to keep getting cash flow? Here, take this note. Like that. Hi, Angel. Thanks for coming in. Very nice to see your picture. And Lisa, we're happy you're here. Like that. So, yeah, so we've been talking about accredited investors and what it takes to get there, and then what you could do with it. So do you have any comments on that? Because we're just about wrapping it up.
Keep close to your sophisticated investors today. They're your accredited investors tomorrow.
There you go. So Angel is a syndicator, so she talks to people who want she takes partners in. So do you ever take non-partners in? Like you borrow the money, you use them as investors that way rather than as partners, Angels?
I've had friends loan us money to get across the finish line.
Okay.
We'll pay them a little bit of interest, and then we try and get them paid off in 30 to 60 days. A little bit cheaper than Ethan's Gap loans.
Yeah, okay.
Substantially cheaper than them. But the majority of what we raise is LP positions. And then we always invest both sides. So we sit GP and LP.
Okay. But you don't take, so when you get your property all fixed up, do you do a refinance and return the capital and keep your LPs in your deals, or do you pay them out?
It depends. Most of what we've done so far is set up to be a 357 turn. But we come from residential.
Can you
Yeah, so a lot of people, not necessarily right now because people are longer term holding, but during the golden decade that has just ended, it was really common for people to buy an apartment complex, get NOI going like crazy, and then sell it within even less than 2 years. And then it was kind of 3 years. There's still people saying they can do it in 3, but given the economic landscape, I'd say you're going to be pretty hard pressed to turn in 3. Maybe 5 to 7. And that's just because you need the longer hold. because of where interest rates are, because you want to let those stabilize. And
Mhm.
they're probably not going to stabilize until whenever the Fed makes its last move, about 12 months after that.
They never have a last move, by the way.
Well, when they're not making moves every couple of months.
So you sell the properties and everybody gets their money back. Do you do 1031s?
We were gonna do a 1031. We had $1 million that was potentially coming in. But it takes a lot more money on our side to pull in 1031 funds, so it needs to be a substantial investment amount to make it worth it.
To bring in 1031, but what about when you get ready to sell? Do you ever do it as a 1031 so that
We never have. We've 1031 from a deal to a deal, but we've never done it personally, like with our own property.
So your deals that you do 1031s out of what you're, and then into the next, and you take all your investors with you. Okay, so you avoid the capital gains.
Yeah, well, that was we were in a deal with Joe Fairless, and that was what he did, and so we 1031 into that because it was like, when else do you get to 1031 with $50,000?
Right. What doesn't matter what it is, still avoiding.
And he gave us the experience, so now we have the experience of what it's like to 1031 something, and we got to do it with a relatively low entry fee.
Okay, great. That's great. So does anyone else, you've been very quiet today, Ted, have any other comments to make? Okay. Well, we're glad you're here. Thanks for coming. And David hasn't shown up. That's very unusual. David didn't show up today. He's usually late, but I don't think he'll be in because it's really late. Anyway, Lisa, thanks for being here. So do you have any other comments or anything else to say, Matt? Because I think we're pretty much winding up on the subject.
Matt, I have a question for you.
Oh, good.
How do you ask for carryback? Like, what do you say?
So generally what I do is I'll broach it kind of softly by asking the seller or the agent, however the property is being marketed, if the seller owns it free and clear, because that's kind of the first step in if they're even able to do it. And then I'll casually mention, are you interested in holding any paper on this? And if I don't get a hard no, what I do is I'll make them a three offer scenario. The first is where I'm offering them full price, but they're carrying back, or they're carrying back a significant amount. I'll make them a second offer, which is under asking. They're carrying back maybe just 20%, and then my bank's giving me the 80. And then I'll make them the third offer, which is significantly less than they want, but they don't have to carry back. And they almost always, if there's any interest in carrying back, they'll almost always take one of the other two offers because they just like the higher number.
Mm-hmm.
We've been dealing with a couple of different reverse 1031s, and I had never even heard of those. So with the reverse 1031, like, you go ahead and 1031 into your next property, but like you front it out. And then when you sell your current property, that's what funds the 1031 purchase.
Right, but you can't be on title on that, on a reverse.
And so we were trying to get her to carry back because it wasn't worth it. It really isn't worth the asking price, but we were buying deductions because we needed like 6-figure tax relief amongst the family. So, but it was just trying. And I guess we never worded it correctly because I think she had some maneuverability there. And I don't know how it works with a boot when you're in a reverse 1031, or if it has to be fully funded in. I don't really understand them.
So what a reverse 1031 is you find a property that you like. You have what we call a straw man. So you have somebody, your real estate agent or whoever, goes in and qualifies. You make sure they have all the cash and everything they need to close the deal. They'll sign the documents. You don't sign anything. They sign everything. Now you could take the time you need to get your property sold at whatever you need to sell, and then you get it sold. And you could do this either while you're in escrow, or you could go through an accommodator, but I would do a simultaneous closing, and you could buy that property. You're now buying that property 1031 into that property at the price that was paid. So you're taking your new mortgage, because you have to now, if you have a mortgage, unless it's free and clear, you're now qualifying for a mortgage. That mortgage will go on that property and pay off the other mortgage and the down payment, just like anything else. It's very simple. People make things complicated that aren't complicated, but of course it's a 1031, and that usually has some, timelines and things like that. That's why it's so important to find the property you want to go into before you ever put your own on the proper up for sale, because it could take years before you get your property sold. And that 45-day identification, that's just over a month. Like, it's not even a month and a half. It's not even 6 weeks.
I think they were saying you get on the reverse, you get 6 months to sell, I guess. But
No, you don't have
I
anything.
just-
No,
Okay.
I don't know who's talking to you. No,
that was what the broker told us, was that she had 6 months.
no, you don't have anything to. Okay.
I didn't say he's smart or that he's good.
So here, whoever
don't-
it is
you-
that buys the
yeah.
other property has nothing to do with you other than you
Right.
hire them to do that. You could take years. You still own your property. You're not going to do the 1031 until you get that property sold. Now you're going to go back to the broker. We'll just say it's a broker that was your straw man, and now you're going to buy it. The agreement was that they would sell it back to you at that price. You gave them all the money. You gave them everything they needed to close. They're just the straw man. But there's nothing there that connects the two of you. Now you buy that property. And if you want to keep your broker in as a partner, you have to do it differently. They can't come in because a 1031 is a 1031. You could put them in as a tick if you wanted. Like that, so that they got a portion of it. So that they'll
So,
do the deal for you.
Are they very common then, or is it just because of what's going on in the economic environment right now? Because it was like I heard of one, and then I heard of another one, and then another one, and I was like, what the heck? These sprang up out of nowhere.
They've been around forever. If you go to First Tuesday, you could go to First Tuesday online. You could buy their book on 1031. I'll tell you everything you need to know about how to do a 1031. Like that. It's a good book. I didn't help write any of it. I hardly can understand some of it. I think I've read it 4 different times because I always used it to renew my license, right? The 1031. And the rules haven't changed on 1031. They're still the same as they were when they were originally set up.
What Peggy's defining, though, at the beginning, it's not a 1031.
That's right. It's not 1031 until you
Until it
sell your
funds in.
property. I'm sorry. Go ahead, Eugene.
Yeah, what she's defining is not a the process she's defining doesn't start as a 1031. It just starts as a straw man purchase. You've got to work out whatever arrangements you need to work out with your straw person and make sure you're getting what you need out of the deal. But then you can do your 1031. So you've got your property identified up front, but it's not a 1031. It technically it's not a 1031 when it starts.
Exactly. It's still called a reverse mortgage. So the idea of a reverse 1031 is when the market's in a down market, you go find your straw man and buy the property that you want. And then when the market goes up, which will be several years later, you sell yours at the high. Now you go in and you buy that property. So you made your profit, and you may have to pay a little boot. Who knows?
So the only caution
Yes, please.
is if you want to keep I have a friend his motto is his job, his company is to keep the IRS off your ASS.
Yes.
That literally is what is and that's what his radio ads are. The only caution is don't mention 1031 at the beginning, especially in front of an IRS person. That's the only caution.
Thank you, Eugene.
I was noticing it seemed to be popular amongst like single owners or family owners in like the $1 million to $3 million range. Once I started looking into it, but it was just kind of, I don't know. And maybe it was that particular activating system or whatever. Once you see something, you see it everywhere.
That's right.
But I'm pretty sure I had never heard of them until we got into that duplex deal.
That could be because you're very young.
Well, I mean, I'm 47.
Yeah, well, they've been around. They've been around. So you might get that book and read more about it, learn more about it. Exeter is Bill Exeter. He's a accommodator. He's been around easily 47 years, and you might have a conversation with him about that and what he's seeing in the market. He's on LinkedIn like that. So anything else, anyone? Because this turned out to be kind of a fun. Matt, so great to have you. I hope you come back again. Love to have you.
I appreciate the invitation. I definitely walked away learning a bunch of things. So it's amazing.
Good, because that's what we're all about. We want everybody to be educated and protected. So thank you.